This is a continuation of our July 17th class presentation on individual income taxes. Before we go on, I need to remind you that remember that all tax thresholds, limits, and tax values are stated under 2016 tax laws, unless I specifically noted that they're values for 2017. The amounts that are quoted within these slides may change for 2017 or subsequent years. And this is very true when certain elements of the tax code the values are indexed for inflation. So keep that in mind. So let's go ahead and continue on with our presentation, and we're going to lead right into a question. Eric borrowed $50,000 of cash, which he secured by his home loan. So he got a home equity loan, home type loan, which is valued at $400,000. The home itself is unencumbered by any other debt, so there's no other mortgage on the property. Now, instead of using the $50,000 on the home, Eric used the $50,000 to purchase a new car. The interest on this loan qualifies as, and you have four choices. Go ahead and stop the video when you're ready, restart the video, and you can view the answer slide. In summary, Eric borrowed $50,000 on his house and used that money to go ahead and buy a car. Under these circumstances, this would be considered B, deductible qualified residential interest. Now, qualified residential interest is deductible subject to the lower of the following two situations. Number one, the interest on the home equity loan up to a limit of $100,000 of indebtedness, or the fair market value of the house less the principal home mortgage. The reason for this type of limitation is that personal interest is no longer deductible except in the case of home mortgages. And in this case, there was basically a mortgage that was brought out on a home for personal expenditures. So the amount of interest that is deductible is limited to the first $100,000 of the amount borrowed on that home, or the fair market value of the house less the principal home and mortgage. Now, that's to prevent abuses of people going ahead and being able to, just because they own a home, being able to borrow against it and deduct the mortgage for personal type of expenditures that are normally not, the interest is normally not tax deductible. Now, in the case of Eric's unencumbered home value is $400,000, as talked about. So the amount of the home mortgage interest would be limited to that first $100,000 of the mortgage liability. Let's take a look now at question number 13, another itemized deduction from AGI. On January the 2nd of the current tax year, Eric borrowed $120,000 of cash secured by his home, which is valued at $400,000. Okay, now the home is unencumbered by any other debt, so that's the only debt on the property. Eric used the $120,000 to pay various personal loans. Now, the interest on those loans would not be tax deductible. So if Eric can go ahead and borrow the money on his home, he can get an interest deduction where he couldn't pay off those loans where he couldn't get the interest deduction for the personal loans. So that sounds like a pretty good tax strategy. Now, the home equity loan that he took out had a 7% interest rate. In this case, then, what is the amount of the qualified residential interest expense that Eric can deduct within a full tax year? So again, this is part of tax strategy. You have 4 choices. Go ahead and make your choices, and when you are ready, go ahead and take a look at the answer. Okay, the answer to number 13. On January the 2nd, again, Eric borrowed the $120,000 of cash, and there was no other loan on the property. So in this case, the answer would be C, $7,000. Now, here's how we compute that. Qualified residential interest is based upon the lower of basically the fair market value of the home less the primary mortgage. So the value of the amount would be, we could take that to 7% of $400,000. However, it's the lower of the two. In this case, the OR is qualified residential interest cap. So you can only go up to $100,000 of loan value. So we take the $100,000 amount of the loan, even though it's $120,000, we're capped at $100,000. So we take $100,000 times that 7% annual interest rate. So the interest on this loan, we could deduct up to $7,000. The remainder on the loan, which is the additional $20,000 at 7%, the $1,400 would be interest, but it would be non-deductible personal interest. Question number 14, and Eric is back. So during the current tax year, Eric borrowed $120,000 of cash secured by his home, which is valued at $400,000. However, in this case, the home is encumbered by a $330,000 mortgage. Okay, Eric used the $120,000 that he borrowed to pay various personal loans. The home equity loan is 7%, or the home equity loan is 7%. So what's the amount of qualified residential interest expense that Eric can deduct for the full tax year? Again, you're given your 4 choices. Go ahead, make your stop the video, make your choice, and when you're ready, restart the video to review the answer. Number 14. Okay, again, the answer in this case, what is the amount of the qualified residential interest expense that Eric can deduct for the full year? And the answer in this case is $4,900. So let's go through the computation. Now, again, the qualified residential interest deduction is a lower of 2 situations. It's a lower of the fair market value of the home, less a mortgage, which gives you a net value of the residence, which in this case, that would be $70,000, $400,000 fair market value, less your primary mortgage is $330,000. So in effect, you have equity, if you will, of $70,000. Okay, it could be that number or the lower, or basically the qualified residential interest cap of up to $100,000. In this case, it's clear that the amount that is lower will be $70,000. So the way we calculate it is $70,000 of that loan, of the $120,000 loan at 7% means we have $4,900 worth of qualified residential interest, which is our answer. The remainder of that loan, the $50,000, is at 7% or $30,500 would be non-deductible personal expense. Number 15. Winthorpe and Penelope own a residence worth $1.3 million. And that residence is encumbered with a mortgage of $800,000. They also own a second residence worth $700,000 with the $600,000 mortgage. The mortgage on their first residence is 5% and the mortgage on their second residence is 6%. Now the question here in this case, these are primary mortgages. Okay, so what is Winthorpe's and Penelope's maximum residential interest deduction for a full tax year? And we're assuming they are married, filing jointly, and you're given, again, your 4 choices. Go ahead, stop the video, and when you're ready, restart the video to review the answer. Okay, question number 15. What is Winthorpe's and Penelope's maximum residential interest deduction for a full tax year? And the answer in this case is C, $52,000. Now, deductible mortgage interest computed on a primary or along with a secondary residence cannot exceed an aggregate amount debt ceiling of $1 million. So in effect, you can deduct mortgage interest, that's still deductible, and you can deduct it up to indebtedness of $1 million. Now, it's $500,000 if you're single or married filing separately. Also, you can't rent your primary or your secondary residence out, and it has to have the characteristics of a real mortgage. Now let's go through the computation that allowed us to arrive at $52,000. Okay, now first of all, you know you can deduct $40,000 of interest because that's $800,000 times 5% on your primary mortgage. Okay, now, or on your primary residence on your first mortgage. You can then deduct the mortgage to the second home to the extent it does not exceed that $1 million limit, which also includes your first mortgage. So when we do the computation, it's going to come out to obviously $1 million limit minus the $800,000 mortgage on your first home. That means you have $200,000 remaining. So we take that $200,000 and we divide it by $600,000, which means the amount of the limit basically remaining on that second home is you're going to be able to deduct 33.3% of the interest. So now we compute the amount of interest on the second home, and that would be the $600,000 total mortgage times 6%, or that equals $36,000 in total annual interest. When you do your computation, you're going to take that $36,000 in annual interest, multiply it times that 33.3%, and you're going to come up with $12,000, and that represents the amount of interest that you're able to deduct on your second residence, and that's subject to, because of the $1 million debt ceiling limitation. So now we can take the $40,000 we can deduct on our original residence and the portion of the mortgage interest that we can deduct from our second home of $12,000. So the total interest deduction for the tax year would be equal to $52,000. Now, if you're thinking you can reverse the mortgages in terms of, oh, your second home could be, we can deduct that first against the limit, that goes against the rules. You have to deduct your primary residence and then your secondary residence. Okay, let's go on. Take a look at question number 16. Again, itemized deductions from AGI interest. Murray purchased a new home for $300,000 on July 1st of the current tax year. Murray paid $60,000 down, and the remainder was encumbered by a mortgage at 4.5%. Murray also had to pay 3 points, and you have to understand what 3 points means. Okay, had to pay 3 points to obtain the loan, and a 1 point, 3 points, and a 1 point origination fee. Murray paid $13,500 in interest payments at the end of the year. Murray's a cash basis taxpayer. What may Murray deduct as interest for the current tax year? Again, go ahead and stop your video, and when you're ready, restart the video for the answer slide. Okay, number 16. What may Murray deduct as interest for the current tax year? And we have to take a look here. We start out with our mortgage interest of $13,500 plus we can subtract out any points paid to obtain the loan. And what we're going to find out here is in this box is points are basically a form of prepaid interest, and each point is equal to 1%. So we had to pay for our mortgage $240,000 because we had a $300,000 home and we paid $60,000 down, so the mortgage would have been $240,000. So $240,000 times 3% equals $7,200. The origination fee is again simply a fee for the mortgage. And in this case, so it's not considered interest. So it's 1%, 1 point of $240,000, but that cannot be deducted as part of interest expense. So the total amount is $20,700, which is B, the $20,700. Now, what we need to remember is, in this case, is points are a form of prepaid interest. Sometimes it's also called discount points. So you may see a question where it says they had to pay 3 discount points or simply 3 points. That is prepaid interest. Points are deductible as interest expense in the year that they're paid for a cash basis taxpayer. Okay, a loan origination fee is also expressed in points. As an example, 2 points equals 2%. However, loan origination fees are not deductible as interest. Now, points are interest, but points paid for a mortgage that is not your primary home are deductible as interest expense, but there's a catch. The total cost of the points must be amortized over the life of the mortgage. So as an example, if you had a $300,000 30-year mortgage with 3 points, that would be $9,000 in effect in prepaid interest. So those points must be amortized as interest expense over the life of the mortgage, or in effect $300 a year, which is your $9,000 point cost over 30 years. Let's take a look now at question number 17. 17 now, we're going to talk about itemized deductions from adjusted gross income, but in this case we're going to talk about charitable contributions, and there are a couple of twists to charitable contributions. Betty is a single taxpayer and she had an adjusted gross income, AGI, of $80,000. Betty has substantiated charitable contributions of $15,000 in cash to her church and $20,000 of used goods to Goodwill. Betty had a charitable gift carryover from 3 previous tax years of $18,000. What is a maximum amount of properly substantiated charitable contributions that Betty could claim as an itemized deduction in the current tax year? Now, when I'm talking about properly substantiated charitable contributions, it means that everything that shows here, all the deductions are legitimate and would uphold during an audit review. So we're given, again, our 4 choices. Go ahead and stop the video, and when you're ready, restart your video. Okay, the question for number 17 is, what is a maximum amount of properly substantiated charitable contributions that Betty could claim as an itemized deduction for the current year? And the answer in this case is going to be $40,000. And we're going to see how that's computed and also learn a little bit about an issue on the limitations associated with charitable contributions. So first of all, she made a contribution of $15,000 to her church. She also made a charitable contribution to Goodwill of property of $20,000. Now, before we go on, let's go here to the charitable contributions description box I have here. Let's take a look at this first statement or paragraph. Basically, the value of property is the current value of property donated to nonprofit organizations recognized by the Internal Revenue Service. And if you want to, you can read, there's a whole number of rules and regulations on the contribution of charitable property. But what we're assuming here is that she contributed a fair market value of $20,000 worth of property. Now, in addition to those 2 contributions, she had a contribution carryover from the previous year of $18,000. Now, before I go on, let's go down to the second box down here. And now we find out there is a limitation to the amount of charitable contributions that can be deducted in any year. And that says generally you cannot deduct more than 50% of your AGI on your tax return for charitable contributions. Any contributions in excess of that can be carried forward for 5 years. So now we take a look and we go back up to our chart here, our schedule, and we notice we have $18,000 of contributions from the previous year. So now we can add up all of our charitable contributions for the current year, and that totals to $53,000. But now that is subject to our cap, 50% of AGI, and Betty's adjusted gross income is $80,000. So that means 50% of her $80,000 is $40,000. That's her cap. That's as much as she can deduct in this year, which is the amount that we showed in our answer C. And then the charitable contribution carryover for the following year will be $13,000. Okay, now let's take a look at another area. And these areas happen to be in the computation of our tax liability, and basically tax tables we're going to be talking about. And also we're going to talk about 1 or 2 items that could be considered credits, primarily earned income credit. So let's go ahead and look at our tax tables or filing. Okay, taxpayer filing status. And again, you just can't pick any status. You have to fit within a status. Now, we're going to start out with married filing jointly. And there's a number of rules, but this is the gist of married filing jointly. Taxpayers who are considered married on the last day of the tax year, you're married on that by that day, and both agree to file a joint return. That's married filing jointly. Married filing separately is taxpayers who are considered married on the last day of the tax year and both agree to file separate tax returns. Now, married can be interpreted a number of ways, and yes, the federal government does recognize same-sex spouses as being married. They also recognize pretty much court orders if you decide you're divorced because of a church annulment. That's not good enough for the IRS. They want to see a court type of divorce or a court type of order. So that's the married side of things. Head of household. Okay, a taxpayer is unmarried or considered unmarried again on the last day of the tax year. The taxpayer paid more than half the cost of keeping up the home for the year, and a qualifying person lived with the taxpayer in the home for more than half the year, except for temporary absences such as school or if you have a parent. Now, single I've left over because that status is considered to an unmarried taxpayer, or the taxpayer doesn't qualify for another filing status. So these are very simplified taxpayer filing statuses that you should be aware of, and some of the rules that are associated with them. Now, let's go on and talk about another area, and it's called earned income credit. The earned income credit is what we call a refundable credit. It's kind of unique. That means it's refundable to the taxpayer. In other words, in cash, it's refundable even if the taxpayer has paid no taxes for the year. Now, you really don't want to be in the EIC category if you can avoid it, because it is made for people with low to very modest means of income. And you're basically qualify for the earned income credit. Your earned income and adjusted gross income must be less than, and you can see basically if you're single, head of household, or widowed, or if you're married filing jointly, you can see the amounts that are involved here. If you have 0 children and you're married filing jointly, your combined income has to be less than $20,000 and so forth, going on up. Now, the maximum amount of credit for the tax year 2016 is that if you have 3 or more children, you can get a credit up to $6,269. That's the top level of the credit. If you have no qualifying children, the bottom level of the credit is $506. Now, the other thing is, you should also know that credits phase out as incomes increase towards a maximum qualifying earned income slash AGI. So let's go over 1 or 2 questions on the earned income credit. John meets the qualifications for the EIC, earned income credit. John's earned income was $20,000, which qualified him for an EIC of $4,600. Jim had $2,000 of taxes withheld, probably from his job, for the tax year. In this case, Jim is going to be entitled to a refund of, and again, you're given your 4 choices. Go ahead and stop the video, and when you're ready, restart your video for the answer to question number 18. Okay, the question for number 18 is, Jim would be entitled to a refund of how much? And in this case, the answer is C, $4,600. Again, the earned income credit is a refundable credit for eligible low-income and lower moderate income workers. And to be eligible for the credit, I've included some other criteria. Must have had earned income in a return that covers a 12-month period. It can't be a partial tax year. Has to have maintained a household for more than a half a year in the event of a qualifying child. So if you have a qualifying child, you have to have maintained the household for more than half the year. Now, it doesn't mean you have to have a qualifying child for the credit, but if you do have a qualifying child, you have to maintain that household. You have to have a filing status other than married, filing single, and you cannot be a qualifying child of another person. And again, as I've mentioned before, the taxpayer will receive the full credit as a refund even if they paid no estimated tax or had tax withheld. So that's the answer to number 18. Now let's go on and take a look at another subject matter that we're going to talk about. Mike is a self-employed contractor. During the tax year, he had gross business receipts of $63,000. Mike's business disbursements were $8,500 in parts for his contracting work, $5,000 in advertising, and he had payments of estimated taxes on his self-employment of $7,500. So these were payments he made to the government on self-employment, $7,500. So what should Mike report as net income subject to the self-employment tax? So net income subject to the self-employment tax. Go ahead, stop the video, and when you're ready, restart and review the answer. Okay, the answer to number 19 again. The question is, what should Mike report as net income that is subject to the self-employment tax? So the answer in this case is C, $49,500. And what we can see is we start off with Mike's gross income of $63,000, and then the parts that he spent for his business work, and also the advertising. Now, the payments he made for self-employment income are not a deduction. They're not tax deductible for arriving at self-employment income. They will be applied against his tax liability, but they're not deductible. Okay, so his self-employment income is $49,500, which is the answer to C. Now, a little more detail on self-employment tax. Individuals with net earnings of $400 or more are subject to self-employment tax. Now, the self-employment tax is 15.3% off of the self-employment income, which we computed above, up to a limit of $127,200. Now that that sounds like a lot, but when you take a look at it, that's basically what every U.S. citizen is paying. And here's how it's comprised. Basically, 6.2% is normally deducted from an employee's paycheck, and the employer then makes up the other 6.2% for Social Security. Okay, 1.45% is deducted from the employee's paycheck for Medicare, and the other 1.45% is deducted from the employer. The employer has to pay that other portion for the Medicare. So actually the 15.3% is the cost that any citizen would incur over Social Security and Medicare, and that's up to $127,200. Now you have to be careful with this amount, at least, because these amounts are normally indexed for inflation from tax year to tax year. Now also, Medicare, Social Security stops at $127,200. Okay, Medicare does not stop. It keeps on going. So what happens is that you still will have, after the 127,200, you're still going to have 2.9% of self-employment income taxed in excess of the 127,200, and that's for the Medicare tax. Then after that, because of the the Affordable Health Care Act, there is an additional Medicare tax on self-employed taxpayers of an additional 0.9% starting at $200,000 of net earnings, or $250,000 if you're married filing jointly. Okay, let's take a look at number 20 now. Okay, the answer to number 20, the question again is, what is my self-employment total tax liability for the tax year? And the answer in this case is C, $6,994. And here's how we calculate it. We start out with the self-employment income we computed earlier, the $49,500. Now, what we're allowed to do is we're allowed to subtract out 1/2 of the portion of the, in effect, Social Security taxes, which would be 1/2 of that. Those taxes would be 1/2 of 14.4% would be 6.2%. And we're also allowed to subtract out 1/2 of the portion of the Medicare taxes. The Medicare total taxes are 2%, so we're going to be able to subtract out 1.45%. So I take my 49,500 times my 6.2%, and I come up with my half my portion of my Social Security would be $3,069, which I'm going to be able to deduct from my self-employment income. I take the 49,500 times my 1.45%, and that comes out to $718 worth of Medicare taxes that I'm able to deduct from my self-employment income. So in effect, the business portion deduction from my self-employment taxable income would be a total of those two amounts, which would be $3,787. I subtract that from my $49,500. So the income subject to my Social Security and Medicare tax would be $45,713. So now to compute my tax liability for the entire year, it would be $45,713 times my 12.4% Social Security tax. So that tax liability would be $5,668. That's the amount that I would owe at the end of the year. And my Medicare tax would be, again, the $45,713 times 2.9%, and that would be $1,326. So my total self-employment or Social Security and Medicare tax liability for the tax year would be $6,994. Now, you can see up here, I had made payments during the year of $7,500. So I'd be able to claim that as a refund, the difference between my liability and my payments on my tax return. If my payments were less than my liability, I would have to write a check for that amount or offset it against any tax refund I'm going to be receiving. Now we're going to talk about an area that nobody really likes to talk about very much, called the alternative minimum tax, or it's also called the if you, on the exam you could also see it referred to as the AMT, alternative minimum tax. And under these conditions, Congress had set this to close loopholes for the richer taxpayers who basically were able to avoid taxes using different tax schemes. And what's happened is that in the past, the Most rich taxpayers have found additional schemes, and now the AMT is affecting even people in the income ranges which it had never intended to affect in the past. But so individuals here may be required to compute their taxable income using an alternate method. And that alternate method means it's going to result typically in a higher amount. And if they have certain what the government calls excessive deductions or tax preference items. And we're not going to go with the detailed computation because they normally don't ask for detailed computations of the AMT on the exam, but they do ask about the concepts of the AMT. So when we do an AMT computation, we start with our original taxable income. We compute that, and that's the amount that you'd normally use to compute your tax liability. But then we have to make adjustments to that taxable income. We have to add back, and most of these are add backs, certain items that will most likely basically increase what we call the alternative minimum tax income, or AMTI. So remember that acronym, alternative minimum taxable income. Also, if there's tax preference items, we're going to have to add back certain tax preference items that will most likely increase AMTI. So you can see already that you're basically, if you have any of these items and we add them back, that's going to increase your taxable income. Now, from those amounts, then we include what we call the tax exemption. And the AMT tax exemption means that these amounts are exempted from the AMTI computation. And in 2016, the exemption amount was $83,800. So it's not that great. It's not that hard, especially for a double income family to hit this amount. If they do have any of these tax preference type of items. So if we take our alternative minimum tax, add back tax preference items, and then subtract out the tax exemption, we then get our AMTI, and then we end up saying the AMTI times 28% equals the taxable tax liability, and the taxpayer pays the greater of the AMT or the regular tax liability. Okay, let's go into a little bit more detail about the adjustments and the tax preferences that generally have to be added back. The first two adjustments that we may have to make to our income, our taxable income, would be excess depreciation, and that means over straight line, and that includes real property that was purchased between 1986 and 1999, and also personal property that was purchased after 1986. So if we've been benefiting and still benefit from accelerated depreciation regarding the depreciation of these properties, we may have to add back that excess amount of depreciation. Also, excess medical expense deduction using the 10% AGI threshold. And in this case, that would affect the people who were over 65, who normally enjoy a lower threshold of 7.5%. Qualified residential interest due to a home equity loan not being used for improvement of the property itself. And we had several examples of that where we talked about qualified residential interest, where a person would borrow money against their home and then use it for, and I think the example I used was the purchase of a car. Interest would have to be added back. No deduction is allowed for miscellaneous itemized deductions. No deduction is allowed for standard deductions and personal exemptions. No deduction is allowed for certain state, local, and foreign taxes. Also, under tax preferences, and again, these are pretty rare unless you're in a very high income area, tax exempt interest on private activity bonds, excess depreciation over a straight line for real property if it's purchased before 1987, and excess of percentage of depletion over a property's adjusted basis. So now let's go on to question number 21, and it says, which of the following itemized deductions are deductible when computing AMT for individuals? So there are 3 items here that have to be added back. Which is still deductible? So go ahead and take a look at the answers and stop the video. When you're ready, restart your video. Okay, and the question again, which of the following itemized deductions are deductible when computing AMT for individuals? And in this case, the answer would be interest on your primary residence. Now, what I've done is I've listed the general adjustments to arrive at AMTI, the add backs, and you'll notice what I've done is I've highlighted each of the items that would be required to be adjusted back. Okay, let's try question number 22. In the current year, Dan, who's single, had a taxable income of $70,000 before subtracting personal exemptions. Dan had no tax preference items. His itemized deductions were state local taxes $5,000. Home mortgage interest deduction $6,000 and miscellaneous deductions of basically of $2,000 that exceeded 2% of the AGI. So the question is, and what is Dan's AMTI? And in this case, I say for 2016, but it could be just simply for the tax year. Again, stop the video. When you're ready, restart the video and look at the answer. Okay, number 22. Again, the question is, what is Dan's AMTI for the tax year? And the answer in this case is C, $77,000. Start off with Dan's taxable income of $70,000. Now we have to add back his state and local taxes, which he was allowed to deduct, so we add those back. His home mortgage interest does not have to be added back to income. That is one of the items that does not have to be added back to arrive at AMTI. And we also have miscellaneous deductions that exceed the 2% of the AGI. We have to add back those at $2,000. So his AMTI is $77,000. Number 23. The AMT is computed as and again, you're given 4 choices. Stop your video. When you're ready, restart the video for the answer slide. Okay, number 23, the AMT is computed as B, the excess of the tentative AMT tax over the regular tax. Okay, with that then, that is the end of our slide presentation. Thank you for your time.